So in this video I'll be going through some of the slides in your PowerPoint set that's listed in Blackboard regarding Chapter 11 and retirement plans. And the government encourages its citizens and taxpayers to save for retirement. And as we'll talk about, taxation on these retirement plans, these qualified plans, are deferred, but they are not eliminated. And the plans can either be sponsored by the and funded by the employer or the employee, or both. As I mentioned, tax deferred does not mean tax-free. It just means a delay in paying the tax, which is generally, in most cases, a benefit. And then the contributions can provide a deduction to the person or company that makes them. So, for example, if someone contributes to their traditional IRA and they qualify, this reduces their tax obligation. It reduces adjusted gross income. And the employer gets a deduction for contributions that they make to fund their employees' retirement plans. So the employer-sponsored plans, employers, as I said, gets this immediate deduction for the contributions that they make. The contributions that are not considered compensation, therefore they are not taxed. And the deferral means that in most cases the taxation does not occur until the funds are withdrawn. There are some exceptions, such as the Roth IRA, which we'll talk about. So there are two primary kinds of employer-sponsored retirement plans. The defined contribution plan, this is by far now the most common kind of a plan. The risk of return on the invested assets now is completely on the employee. Funding the plan is generally voluntary by the employer. The old-fashioned, more traditional kind of retirement plan was a defined benefit plan. These are very expensive for the employer because they generally fund the pension plan and they guarantee a retirement benefit. All the risk, most of the risk I should say, of these defined benefit plans are borne by the employer, and that's why so many employers have cast off these defined benefit plans in favor of the defined contribution plans. And an example of the defined contribution plan is a 401k. There are certain rules in order to qualify for these tax benefits by the IRS. They can't be discriminatory. Generally, they have to be available to all the employees. And there's some minimum vesting rules, and vesting just means that the point at which the employee is entitled to the employer contributions to the plan. And some of these plans can be contributory or non-contributory. Contributory means that the employee may contribute to the plan as well. And there are some limits to the defined contribution plan. You can't exceed $54,000 annually. Two of the plans or a combination of plans, or 100% of compensation. And there's a limit there. Additions to defined, now this is defined benefit plans, can't result in benefits more than $215,000 or 100%. And so we have these two rules. One applies to the more common defined contribution plan like the 401k or 457. And the third bullet point and the second qualifying threshold is the $215,000, and that applies to the defined benefit plan, the one where the employer bears most of the risk. So the more common, as I said, is these defined contribution plans. 401k is one of the most common. And again, in order to qualify for the benefits from the IRS and the Department of Treasury and the government, is that they have to meet these non-discrimination rules. Employee can elect to defer up to $18,000 to a 401k annually, and or 50 or over a, you can add an additional $6,000, so $24,000 would be the maximum. This additional $6,000 is considered a catch-up. At least it's some effort by the federal government to allow those who have not fully funded plans perhaps to provide additional annual contributions. Keogh plans, these are for the self-employed people, a similar $54,000 limit that we talked about earlier, or 100% of compensation. Another kind of plan is a simplified employee pension plan. Here the employer creates and contributes to the employee IRA. Maximum contribution for this SEP plan is 25% of the compensation, say on a maximum of $270,000 of income. And then the other limit is $54,000, whichever is lower. Another plan for small employers especially are simple plans. Some employers may have a simple IRA. Could be a 401k. They're much less expensive to administer, less expensive to fund in most cases. The employees is more limited though to what they can contribute to their plan, only up to $12,500. If you're over 50, add an additional $2,500 or $15,000 total. And in these types of simple plans, the employer can make a matching contribution of 3% employees who contribute, or 2% for all eligible employees. And the difference is that 2% of eligible employees means that this is paid whether other employees are contributing to their own plans or not. The 3% is a match, so a maximum of 3% match for those who do contribute to the simple plan. Also, individuals can fund their own retirement away outside of the context of the employment situation, and one is through a traditional IRA. The other is a Roth IRA. Same limits, $5,500 for 2017, or 100% of a compensation, whichever is lower. And again, 50 or over, you can add $1,000 to total $6,500. So there is a slight allowance for an additional $1,000 contribution for 50 and over. So regarding the individual retirement plans, there are some limits to contributing to the IRA and getting a tax deduction for the year of contribution for a traditional IRA. And this benefit begins to phase out as AGI reaches $99,000 for a married filing joint and $62,000 for others. And at the point in which the married and others reach $119,000 and $72,000 respectively, it's completely phased out. That is that you can, if you made contributions to a traditional IRA and your income is this high at $119,000 for a married couple, you can still make contributions to the plan, you just cannot deduct them. Roth is very different. Roth contributions are not deductible at any level. But the withdrawals upon retirement, in most cases, the withdrawals are not taxable. Higher phase-out limits for the traditional IRA that has similar limits as the higher limits than the traditional IRA, and as I say, it has similar limits to the traditional IRA. Phase-out starts at $186,000 for married filing joint, $118,000 now for single and head of household, and $0 for married filing separately. So to compare the traditional IRA versus the Roth IRA, contributions are deductible for the traditional, as I said, but not for the Roth. And they're only deductible for the traditional IRA in the event that they qualify for this, that they don't have a pension at work and that their income isn't too high. There are other distinctions between the two, but these are the primary differences between traditional IRA and the Roth IRA. We'll go through some problems in the video that will take a deeper dive into these types of retirement plans. Another kind of tax-deferred non-retirement plan is the Coverdell Education Savings Account. So here, although contributions are not deductible, any earnings that are contributed for an education plan are tax-free. And you notice we're not saying tax-deferred in this case, we're saying tax-free. And so as long as those proceeds from these Coverdell or CISA accounts are used for qualified education expenses of the beneficiary, then the earnings on those funds over the years will never be taxed. The CISA can be opened up and fund any person. There are limits, annual contribution limits of $2,000 per beneficiary from all sources combined. And then the contributions phase out when AGI, the contributor, reaches 190, so they're quite high, or 95 for everybody else. And then it's phased out completely at $30,000 or $15,000 above those numbers. So $120,000 and $110,000 respectively. The distributions then are taxable if the contributions were deductible at the time they were made. So a traditional IRA, if you were able to make contributions that were deductible, then upon retirement, when you receive distributions from your IRA, then they will be taxable. Roth, there was no upfront deductibility benefit. Therefore, when the benefits are withdrawn or distributed, they will not be taxed. And when some of the funds, the contributions were made with previously taxed dollars, and they may be partially tax-free. So there are required minimum distributions the federal government mandates. So in other words, you have to start taking funds for some of these plans when you reach 70 and a half. That is to say, the year April 1st of the year following the year that you reach 70 and a half. You have to start taking these minimum withdrawals. In the text there are calculations that we'll run through that will help us determine how much we need to withdraw. They're based on life expectancy tables that are published in the text as well. I mentioned earlier that Roth IRA distributions are generally not taxable. Distributions are made prior to holding the Roth IRA for 5 years, then the earnings are taxable. Distributions still would not be, since there was no tax benefit, no tax deductibility when you made the contributions. Riverdale Education Savings Accounts, as I said earlier, distributions are tax-free as long as they're used to pay qualified education expenses. Any premature distributions are generally subject to a 10% federal penalty, with some exceptions, and those are listed on page 1117 in your text. I said earlier, an annuity is a series of payments pursuant to a contract, often an insurance contract. Annuity payments are partially taxable in most cases. That is to say, your contributions to the annuity are not taxed. In most cases, when you receive your payments, the insurance company, for example, will tell you every year how much of the proceeds you received, your monthly payments, are taxable and how much is not. I said earlier, the portion of the payments that is represented by the cost of the contract, in other words, the dollars you put into the contract, is tax-free.